Welcome to Understanding Your Tax and Reporting Requirements based on the scale of your New Zealand activities. I'm Rebecca Gans, and I have with me today Maurice Aurelius, a partner who specialises in overseas tax.
Hi Rebecca, and thanks for the invite today.
A pleasure. I also have Anne Todd, a partner who focuses on financial reporting and auditing matters.
Hi Rebecca, great to be here.
Good to have you. And so today we're going to be looking at the 4 typical activities that businesses should do in New Zealand, and also provide listeners with an advisor checklist. Murray, could you kick us off by actually looking at the first of the typical activities people and businesses do in New Zealand?
Certainly, thanks Rebecca. If you're coming to New Zealand for a specific project or contract, then often the first step is going to be to submit a tender. And that's a good time to start planning ahead and thinking about the tax obligations for both the business and the individual employees. It's important to understand the impact that tax and the structure of the contract could have on your contract price and on the tender that you put in. We'll typically work through a range of issues with clients, things like which entity in the group should be the contracting party, should there be a split contract, what tax costs need to be priced into that tender, and what compliance obligations can you expect to encounter once the business is up and running. As with tax, you should also look at understanding your financial reporting obligations in advance and the costs incurred there.
That's right, Murray. The financial reporting obligations kick off from the time in which you're successful with that tender and are getting going with your business. Those can be much more significant than you expect. Often those contracts are small from a financial perspective globally, but here in New Zealand those obligations can be onerous.
So that's submitting a tender. What about an overview of if you're sending people to New Zealand?
Well, it's pretty common that the first dipping of the toe into business in New Zealand is to send people here. And when sending staff to New Zealand, you should consider the implications for both the business and for the individuals. Will their role and their presence here cause the business to be taxable? Are they going to be here long enough to be taxable in their own right? And it's important to understand the impact that an employee's personal circumstances can have on the business. For example, depending how long they're going to stay in New Zealand, that could cause the business to have an obligation to deduct PAYE from their salary. And that duration in New Zealand may not just be the contract or the project that they're here for, it could include holidays they take afterwards. You may also wish to consider whether you'll be tax equalising your staff. What I mean there is there's often differences between the New Zealand tax rates and the tax rates that the employee would have suffered in their home country. Some businesses choose to equalise their staff for that difference. It's a great way of taking tax off the minds of the employees and let them focus on their job, but it can actually be quite an expensive exercise, and so some sort of cost projection is quite useful there. The first trigger point to focus on, though, is making sure that you know the activities that are going to be carried on in New Zealand and whether the individual employees or the business need to register with the Inland Revenue.
Excellent. So we're taking the business to the next level. What happens if we establish a business in New Zealand?
Well, when a business is getting set up in New Zealand, we need to determine how that should be structured, as that can have an impact on the tax costs that are going to be suffered throughout the life of the business. In the early stages, the issue is whether the business has a permanent establishment here. And by that I mean whether they've got a taxable presence that will cause the profits from New Zealand to be taxable here. And also whether there's some relief under a double tax agreement for that. As the business becomes more established, a whole range of questions arise. Should the business be operated through a branch or a subsidiary? How should it be funded, debt or equity? And how should goods be imported? And is the supply chain that you have tax efficient or not? And it's that structure, the funding, all those sorts of things that factor into how much tax the business will pay in New Zealand. And it can also have an impact on the financial accounts.
That's right. Depending on whether or not you choose a branch or a subsidiary structure will have different financial reporting consequences. Any of those can be mitigated if you plan well ahead.
Anne, what are the implications of acquiring a business in New Zealand?
There are several implications of acquiring a business. Very important that you plan and get the legal and tax structure that meet your objectives. You could end up buying shares in an existing company, or conversely you might just pick up the business and their assets. Thinking about your funding, is the funding coming onshore or offshore, will all have implications on your financial reporting and the tax obligations.
That's right, Anne. And an immediate consideration from a tax point of view is what to do with the purchase costs, so the cost of due diligence and that type of thing, making sure that they're incurred in the right place so that you can maximise the tax deductions and also the recovery of GST if that's incurred on those expenses. But regardless, you need to think about the tax consequences throughout the life of the business. So what profits of the business are going to be taxed, how is money going to be repatriated offshore, and also if you choose to exit the business later, what tax consequences might happen there. All of these depend on the structure that you use to acquire the business and need to be thought through now. And then finally, when acquiring a business, it's pretty common to encounter an employee share scheme. Either you inherit an existing one, or you might choose to set one up yourself to retain key staff. Either way, it's important to make sure that the tax consequences, the financial reporting consequences are all considered, and also, just from an HR point of view, making sure that that scheme's achieving what you want it to.
Excellent advice there on those 4 typical activities in New Zealand. It's time to have a look at those checklists. In terms of actually hiring an advisor, what do we have in terms of a checklist to help them bring a business over to New Zealand, Anne?
This first checklist is focused on what to think about from a business perspective. If you give some thought to these questions before you contact your advisor, it will help you save time and money and let you focus on the really important things when you're setting up your business here.
And how about staff? What are the key things they need to think about?
Again, a relatively short checklist, but if you spend some time actually thinking about this before you get here and before you contact your advisor, you will have the answers to the questions they'll be asking you about.
So use those checklists. That's excellent. So thank you very much for your time today. I do appreciate it. Murray?
Thank you, Rebecca. It's been a pleasure.
Anne?
Thank you, Rebecca.